Many of you probably know that I like to cover different buyer's remorse stories from time to time, and today is by far one of the most interesting ones that I have heard of because it pertains to people who bought during the pandemic that actually got really good deals. People that bought homes that are far below prices that we see today and have some of the best interest rates that were ever available to anyone buying a home. You're talking in the low 3% range, even some of them I believe are below 3%, which is fantastic. And the first thing that comes to mind is, why would anyone like that have buyer's remorse, right? Because you basically got the deal of a lifetime that no one will probably ever get again. Well, let's look into this and find out why people like this have some regrets. The first buyer's remorse story is actually from a 38-year-old realtor in St. Augustine, Florida, which is, by the way, one of my most favorite areas of Florida. I may end up moving up there one of these days. But she bought a home back in January of 2020 with an FHA loan, 30-year mortgage. The house is only $215,000, and she has a 3.25% interest rate. Not bad, right? And her monthly mortgage payment comes out to about $1,300 a month, which includes her taxes, insurance, and her HOA dues. And she put about 10% down. Now, it is a townhouse. It's not an actual house like these places you see behind me. And by the way, for those of you who are curious, today we are in Eastern Shores, Miami. So we'll take a look around here. So the problem with her purchase is that the house is small. It's a townhouse. It's only 1,000 square feet. And she has 2 kids, and when you're trying to have 4 people live in a small 1,000 square foot townhouse, it can't be easy, to say the least. I mean, I see 1-bedroom apartments sometimes around here that are bigger than that. So trying to squeeze that many people living in such a small place cannot be easy. She bought this place thinking, well, this is the greatest starter home because it's affordable and it's in the location we need it to be in, especially for the kids' schools. And the idea was, in a couple years, we'll sell it or rent it out and move on up to something else. Well, obviously that plan has backfired given the situation of where interest rates are today and just how much home prices have gone up since January of 2020. So now her only option, if she wanted to do something like that, would be to move way inland, which is basically not an option for her. And she's in this position where she either has to have home prices come down or interest rates come back down in order to make moving an option. And I think one of the big mistakes that people make in positions like this is they assume they'll be able to move up to something better later on because, you know, their house will appreciate in value and they'll have some money to move. But the thing that people really make the mistake on, if you ask me, is they think they're going to have the money to move without selling that house, and a lot of times it's just not the case. It's always so interesting to come across properties like this one that is basically just a shell. This house is an old house that needs to be completely torn down according to the listing, and they want basically $2.5 million for it because it's a waterfront house and you're just buying the land at this point. And even during the last real estate bubble, as we can see in 2008, this house sold for $950,000, and now today they want $2.5 million. You see, one interesting thing about this area here is that you got houses behind me here, and then you got condos when you cross the street and go to the other side of the island. So it's like the left side of the island that we're on here now has these houses, and then the right side has condos and townhouses. So we'll check out over there too. Now this next person has a pretty similar story, if you ask me. He bought a house also in 2020, and he got a 30-year fixed mortgage for 3.25%, and he put only 5% down, so obviously not a huge down payment, and he only paid $207,000 for the house. Now his monthly mortgage payment with those stats comes out to $1,263 a month, so not bad at all. Far less than what you'd even be paying on a 1-bedroom apartment somewhere here now. Although it is a condo, it's a 2-bedroom condo that they bought, and it's him, his partner, and now they had a baby. So they're wanting to move up to a bigger space, which is something that's very common and happens to people a lot when they end up having kids. But here's the catch, guys. Now that he wants to move up to a townhouse that has a yard, something bigger, to raise his family in. He's looking at places that are in the $400,000 price range, and at a 6.5% mortgage rate for a 30-year fixed mortgage, even with a 20% down payment, that's putting him a little over $2,000 a month for his new potential mortgage payment, and that's over an $850 a month jump from where he's at right now, which is basically unaffordable for his monthly budget. And pretty much the only option that they have right now is to try and make the place they have work, because moving under these circumstances is just not feasible. He's pretty much in the same boat. I'm gonna wait for home prices to come down and rates to come down. And what do you notice so far for these first two stories? Having these high interest rates and having home prices being high is actually bad for sellers too, because as we can tell just from what these first two people have said, they would be listing their homes on the market and trying to move up to something that suits their needs better if lending conditions were more favorable, and ironically, if prices were lower, because there's more to real estate than just cashing out at all-time high prices, because you always got to remember you're also going to be facing all-time high prices when you're out there as a buyer. So it's a very tough position to be in, and really the only option for people like this is to sell, collect your nice profit on the property since you bought it a few years ago, and move to a cheaper rental if possible and wait it out a little bit, or you have to relocate to a much more affordable area where buying a home just costs a lot less. And for people that are trying to put down roots and raise families like this, that's usually not an option. Now this next one, he's a 27-year-old and he has the best deal of all. He has a 30-year rate locked in at 2.625%, and he bought in October 2020 in North Lake, Texas. He bought a house for $420,000, also put 5% down. And what else do you notice here, guys? All these people, they don't have a lot of equity from the very beginning. They only put 5% down, and then the run-up in home prices really helped them create equity. But if it wasn't for this giant run-up that we saw, these guys really wouldn't have much equity at all. So keep that in mind, because that's really important for buyers who are looking at buying today. And even under these favorable terms that we just discussed, his monthly mortgage is still $2,900 a month. So quite a bit higher than the last few people that we talked about. And he's been running the numbers with his real estate agent and mortgage broker to see if he can afford something else. And basically what it comes down to is it's not going to be affordable for a guy like this to move right now either. So you can see right here from these first few stories that these are all potentially would-be sellers, and they're not selling because they're not able to. They're being forced not to sell. And the problem comes when people like this hit some sort of financial hiccup and they might need to sell, not because they want to, but because they have to. And that can be very problematic for somebody in this position, because they're giving up the deal of a lifetime potentially because of financial hardship. Now this next person is coincidentally another realtor, so 2 out of the 4 people in this story are realtors, and you would think that as real estate agents you would have a little bit more knowledge and a little bit more outlook on how things might play out, and apparently they're not watching these videos to give them a clue that maybe this would happen to them. But anyways, he's a 34-year-old realtor in Tucson, and he bought his home in 2021, 30-year fixed rate loan with a VA loan, has a 2.75% rate. And he actually put an $80,000 down payment, so I'll definitely give him some props for that, because VA loans are typically 0% down. So starting off the property with an $80,000 down payment is pretty good. So his monthly mortgage payment is a little over $2,000 a month, which includes taxes and insurance. And just like all the other sellers we talked about, he has a young family, wants more space, and can't do it because of where prices and interest rates are. And his main excuse is, well, if interest rates were lower, I would be able to move, which is also not true. Because if interest rates were still in the 3% range or 4%, imagine where home prices would be. They're already too high, but if they were that low, then essentially home prices would be uncapped and continually going up. So the reality is low interest rates is only part of the equation, and everybody has a very short-term memory, especially including this realtor, of how much the low interest rates actually helped home prices go up uncontrollably. And if we still had 3% rates, just imagine where the market would be right now. Probably maybe another 15 to 20% higher than where it is, which would make it more unaffordable than it would be at these rates and prices. So be careful what you wish for, because any of this is really not good. You know, that's why I think we've reached the limit, right? We've reached the limit of where all of this can go. People who are big proponents of the housing market continuing to go up forever, it's just not going to happen. We can even see that people who would be home sellers right now are not selling because they are financially trapped in these supposedly amazing deals they got. And the real lesson from this story is that no matter how good of a deal you get when it comes to your interest rate or the price that you pay for the property, there can still be buyer's remorse, guys. And that's what makes this story so surprising. And this is also why I tell all of my viewers that when you buy real estate, unless you're looking at flipping the property, you need to be in it for the long run, regardless of what you paid, regardless of your interest rate, because all of those things can work themselves out over time. But what's the other common factor between all these people? They all bought during the pandemic, when it was seemingly the best time ever to buy, and in some ways it actually was. But the big mistake that they all made, including 2 out of these 4 real estate agents, is that they didn't plan for the long term. They thought, oh, I'll buy this place now, and in a couple years I'll turn it around, make some money, and move somewhere better that suits my needs, not thinking about all of the consequences from trying to do that. They didn't look at, well, the Fed's going to continue with interest rate hikes. Where do you think mortgage rates are going to go? It's going to get more expensive to finance. Maybe they thought they would be earning more money than they are right now and be able to move on to another property without selling their existing one. This to me also highlights another problem that I think a lot of people don't think about when it comes to buying a property. The mentality here for these guys was, well, I'll buy something and either sell it or rent it in a couple of years. And a lot of proponents who say the housing market will continue going up forever say that people like this, well, instead of selling, why would they sell? They got these low rates. I'll just rent it instead. Well, as you can see, a lot of these people are not in the position to do that simply because they don't have the down payment and the income and the debt to income ratio to qualify for a bigger, more expensive house, which is what they all want. They all want more space. And at these rates and prices, they can't do it without selling, okay? And selling puts them in an even more vulnerable position where they have nowhere to live. And even though it gives them that down payment back because of their built up equity so far, it still doesn't give them a lot of options when it comes to choosing a place to live, because inventory today is still quite a bit lower than it was in early 2020. And combine that with these rates, these guys are just stuck. They're basically people that got great deals and they are stuck in their homes. So when you go to buy, guys, and this is very important for people that are looking at buying in 2023 here, you need to be in this for the long run, because if you think these people got it bad, they don't. Compared to what you're gonna have it if you buy right now, you're going to be in a much worse position if you think you're going to have one of these similar exit strategies, because if you buy right now, you're going to be facing way more problems. You're going to be facing home prices going down. You're going to be facing less buyers able to qualify out there to buy your home. You see how long homes are sitting on the market now in many cases, or just not even selling. If you go into financial hardship somehow and can't pay for your property, you won't have any equity. You'll be upside down on your mortgage, and you'll be forced to either short sale that property or potentially even face foreclosure, which is far worse than what these people are facing. So you've been warned. And the reality is we still have a lot of potential problems coming with real estate because of the banking crisis. In fact, it was just predicted by Morgan Stanley that the commercial real estate sector is potentially facing a crash that's bigger than 2008 because of all this banking trouble that we've had. All of a sudden it started to rain. I'm gonna hide underneath the the building here for a minute. It's probably just going to be a short little shower. It'll pass. You know summer's getting close when we start getting these random rain showers. Well, I'm just going to keep going under here if you guys don't mind. And here's the problem with the commercial sector right now. There is about $2.4 trillion in commercial debt that is set to reset within the next 5 years. And when this happens, the people who own these commercial properties are going to be in big trouble, essentially, because they will not be able to refinance those properties at lower rates than what they have right now, which could double their mortgage payments. And when that happens, at the same time you have businesses letting go of their office space because of more remote work. This is a 1-2 punch for the commercial sector. And as more commercial properties potentially go into foreclosure and have problems like this, then you're likely to see the economy get even worse, guys, because businesses that actually do rely on this commercial space and still have physical locations are going to be affected by this, with potential business closures, which leads to layoffs, which leads to people not having as much money. And at times of high inflation like this, you can see how that can be devastating. And the other problem is regional banks are holding a significant number of these commercial real estate loans in their portfolios. And as these businesses can't pay for these loans anymore and there's defaults, it puts even further pressure on the banking system, and it's just not looking good, guys. Wow, look at that, I got lucky. It is pouring all of a sudden. I think I forgot to check the forecast today. It'll pass. So the real problem is there's no easy way to fix this. Interest rates are not likely to go down anytime soon. And as more of these commercial loans are set to reset, I don't know what these people are going to do. Are they going to default? Because we've already seen the defaults tick up on this. Are we going to be facing a world where hardly any business has a storefront anymore because these commercial buildings are essentially going extinct? I don't know. Time will tell. It's something we need to keep an eye on, because if you think this isn't going to affect residential real estate and consumer spending and jobs, you're dead wrong, because it's going to have a major effect on all of those things. It's already almost over. See, it's only spring. It feels almost like summer out here with these surprise rainstorms. Now, one of the largest complaints I've seen from some people in the comments, and even something that I can comment on from somebody who made it all the way through the educational system, through high school, is the lack of financial education in schools. Well, it turns out there are now a total of 18 states that are requiring high school students to take a personal finance course before graduating from high school. That is definitely a step in the right direction. How good this personal finance education really is and what they're teaching them, I don't know, but it sounds like maybe it's better than nothing. But apparently 28 other states have some personal finance bills pending where they want to start increasing this in the educational system. So right away when I hear this, I think that that's probably a good thing, as long as they're being taught the right things, because there's a lot of misinformation when it comes to financial education, that's for sure. But so far there's some research on this, and apparently the kids who are required to take these courses versus the ones who aren't required to take them are more likely to tap lower cost loans and grants when it comes to paying for college. And they're less likely to rely on private loans or high interest rate credit cards. And they're also more acutely aware of the financial strains that come with going to college. And the early signs are also showing that these students that had to pass these financial education scores tend to have better average credit scores and lower debt delinquency rates. And these young adults are more likely to meet ends meet every month without falling short and having to rely on credit. And they're more likely to make their loan payments on time, whether it's a car loan, credit card loan, whatever. They're likely to have less debt. So it does appear that this is actually working, at least if this data is accurate. And what this highlights is that people that don't get any sort of financial education in their early years are far more likely to get themselves into trouble than people who do get a basic financial education. Now, my personal opinion is that students should be learning about this from a very young age, because I think the younger you start learning about money and finance, the better. Like, for example, when I was a kid, I used to love earning money, guys. If I could do some chores for the neighbor next door or around the house and earn a few bucks by cutting someone's grass or, watering the lawn or whatever, then I would do it, because I always used to be fascinated with earning money. I used to see my parents and other adults earning money and what you could do with that money. And as a kid, since you don't actually make any money of your own unless you do things like this, it made me want to earn money. Like, it gave me a big desire to earn my own money, because it felt very rewarding to have a few bucks that you could spend on your own. I used to save up a little bit of money to buy the latest CD from one of my favorite bands, or I remember one summer I saved money all summer long from doing chores just to buy a stereo to play those CDs. And those are the kind of things that teach you financial education from a young age, I believe. For the record, when I was in school, we didn't have any financial education courses, but I did take accounting courses all throughout my high school years. From freshman year all the way through senior year, I took accounting, and my last 2 years, I was in the advanced accounting class. It's the only advanced class I was ever in, and it's one of the only classes that I ever scored all A's in, so I was very good at it. And even though accounting is not directly financial education, it kind of gives you financial education organically by learning how to crunch numbers, learning how to do profit and loss statements, learning how money flows in and out of businesses and people's personal checking accounts, how money is spent and saved. By default, I kind of learned about money through these accounting courses, and earlier in the years when I just wanted to earn money for myself and feel like what it was like to save up for something special and turn around and buy it. In fact, I kind of equate it to when I was younger and I learned how to play guitar. I got my first guitar when I was 13 years old. I learned how to play a few things on my own through a VHS tape that came with my starter kit. But a few months later, when I started guitar lessons, I went into the guitar lessons to my teacher, and he asked me, "So what do you want to learn?" I gave him Nirvana's CD, Nevermind, and said, "Teach me how to play this," And that was kind of the beginning of learning how to play guitar. And the way that this is similar to financial education is because even though I knew nothing about playing guitar, by the time you learn how to play a couple of songs, naturally you learn different things that are important when it comes to technique in playing guitar, and just how to do things naturally that you pick up when you learn how to play a song. And I think learning accounting is very similar to that when it comes to learning about money. So say if you're younger and you're watching this, or you have kids that are going into high school, for example, and they don't offer these financial education courses, talk to them about maybe taking accounting, because accounting, I think, was one of the most valuable courses I ever took when it came to learning about money. I think it did pretty well for myself. And to be realistic, guys, I hated most of school, but I actually enjoyed accounting class quite a bit because it had to do with money, and that's something that I've always enjoyed learning about. So I would suggest you have your kids take accounting. Obviously, they need to have an interest in it on their own. You can't force them to do it. I definitely just had an organic interest in doing it, so it was a no-brainer for me. But just a heads up, in case your school is not offering financial education just yet. If you guys enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I post a new video. And if you don't want to wait, check out my next one on the screen right over here, and I'll see you in the next one.